Good morning, everybody. My name is Debbie Bannister with Exchange Resources. And we are going to talk about today the introduction to a 1031 exchange. We're going to go in through all the ins and outs and the things that are really important for you as a real estate professional that you to know in regards to how to help your client that may need an exchange. So we'll go ahead and get started. I have an assistant. His name is Frank. He's going to help turn my pages for me. So let's move on, Frank.
Okay.
Go ahead. Okay, so to begin our discussion, I want to start off by saying that a 1031 exchange only qualifies for investment real estate. So if somebody has investment real estate that they want to sell, which is a rental or something used for a trade or a business, then that property is the type of property that qualifies for a 1031. The type of properties or personal things that don't qualify would be the primary residence, with few exceptions. So we're going to talk about that in our presentation. A second home does not qualify because it's used for personal use. Property held to sell, flipping. So properties if you buy it with the intent or the motive to flip, to fix and flip, do not qualify. Stocks and bonds and REITs are stock transactions. They do not qualify. And partnership interest does not qualify. Mortgages and promissory notes and seller carrybacks do not qualify. Okay, we can talk about if anybody has questions, you can put them in the chat in regards to any of these, but we'll move ahead. So before we get started talking about exclusively investment property, I wanted to bring up, because people get this very confused, and I wanted to bring this up, the primary residence, and then we're going to separate it out. With the tax code, there's 3 types of properties that IRS deems as real estate. We have the primary residence, second home, and investment property. The primary residence has its own tax shelter, and that's what this screen talks about. It's referred to in the tax code as the 121 universal exclusion. And basically something we all probably know, and I won't spend much time on, is that this applies to someone that's owned the property and lived in it. So owned it and used it for 2 years consecutive, or in the last 5 years of ownership, they can add up 24 months in the last 5 years of ownership, then they qualify for this exclusion. If they're married, they can have the first $500,000 of gain excluded from having taxes. If they're single, it'll be $250,000. But any gain over this limit, so if you sold a primary residence and you're married and you had a gain of $600,000, so anything over the $500,000 will be taxed. So in that example that I just gave, the $600,000, the last $100,000 would be taxed. So anything over these limits would be taxed in the traditional primary residence. The next thing that we talked about that does not qualify is vacation homes. But there is a criteria. If it's met, if it's followed, then it could convert this property from a vacation home or a second home to a vacation rental. So this is how a second home does not qualify, but a vacation home for vacation rental could qualify if you follow these rules. 1, it needs to be held and owned as an investment property for at least 2 years. First thing. So if you had a rental property, a vacation home, and you've had it for more than 2 years and you've been renting it out, it qualifies. The next thing that makes it qualify is if the property has to be rented out at least 14 days each year. So I've had this property for 2 years. I've rented it out for 14 days each year. That's very important. Or if I rented it out more than 14 days, then I could use that property for 10% of the time rented. So this is the criteria. You have to rent it minimally 14 days a year. You cannot use it more than 14 days a year. Or you can rent it for rent it out for, say, 300 days. And you can use that property for 10% of the time rented. So my example, I rented it out for 300 days. I can use it for 30 days and it would still be considered as investment property. But some people may have a home like in the desert. So they have a home here in Orange County and they have a home in the desert. And maybe they live 6 months in the desert, 6 months in Orange County. Well, the home in the desert is their second home. That does not qualify for a 1031, or it does not qualify to be classified as investment property because it was used more than the time frame that was the criteria that I just gave. It was used more than their 14-day allowance or 10% of the time rented. So that if that's the case, then that type of property would be a second home, not an investment property. So I guess the most important takeaway point from this is that if somebody has a property that's rented on Airbnb or some other vacation rental site, that does qualify. They just have to watch their personal use and not use it more than the 14 days or 10% of the time rented. Okay, let's go on to the next. So the big question is, what exactly is a 1031? So 1031, to begin with, the number 1031 is the section of the tax code that this comes from. So that's the tax code section 1031. And what a 1031 is basically it's a transaction where a taxpayer is going to sell investment property and then they replace it with more investment property that they're buying. So they sell it and they replace it with more investment property. By going through this dance, if you will, this is the beginning to what IRS says as far as being able to defer the capital gains tax. Investors are doing them because of that deferment. If they were able to not pay capital gains tax on an investment property they sold by doing a 1031 exchange, and then they find a replacement property that they can buy, that capital gains tax on the sale property will just be rolled into their new property. Thus, they're able to use all their proceeds to buy more investment property. So 1031 exchange is basically a trade. They're taking what they're selling and trading it for a different replacement property. And that tax deferral is, some people think that's the benefit behind the 1031 exchange, that they don't have to pay the tax at the moment. It really isn't the benefit. We're going to get into the next slide or so what the real benefits are. But let's talk about the taxes and the money that the client could save. So we see this screen here. The very first section that we see is that the federal capital gains tax, the light blue, that can go up to 20%. Now that's just federal. So if somebody was selling a piece of investment property, they can have up to 20%. For most people, it's 15%. And that would be their federal capital gains. The next category that I want to talk about is the fourth one down. It's called the state rate tax. And that's the state is up to 13.3% taxes. So between federal at its highest is 20, state at its highest is 13.3. That together is a capital gains tax. Then we have something called depreciation, the third one down, depreciation, recapture taxes. So the recapture of the depreciation. And that's the orange section over here. So the orange shows us that 25% of the total depreciation taken since owning that property as investment property will be tallied up by their CPA or tax professional. And then the taxpayer will pay back 25% of that total depreciation. So for example, let's say the total depreciation, and this is on top of the capital gains tax. So let's say the total depreciation was $100,000 that was taken. Then they have to pay back 25% of that $100,000, which is $25,000. Now that is a separate tax bill, not a capital gains tax. I wanted to differentiate that. Then the last tax that I want to talk about is the second one down, the Affordable Health Care Surcharge. And this is it was called the Obama Act, Obamacare, and it's a Medicare surcharge. So for any taxpayer with passive income, if they're single of 200,000 or greater, if they're married, anything greater than 250, then every dollar past the 200,000 or 250, depending on your status, you would have an extra 3.8 that would be taxed. So that's the Medicare surcharge. So as you can see to the far right, this is based on $1 million property with a $700,000 gain. Without an exchange, the approximate tax bill could be as high as $245,000 or $35,000. I mean, 35% of that gain. So that leaves about $755,000 to reinvest. It takes a bite out of that. But if you did a 1031 exchange, and you deferred all the capital gains tax that we just talked about, then they would have their $1 million to reinvest. So that's really important. So this is showing us not getting out of paying the taxes, because this is deferred, so they're not getting out of anything, but deferring that taxable event to another time allows them to use all their gain to buy more real estate. So that's a real blessing. Go ahead. Now, California has the withholding that I want to talk about. So if someone's selling an investment property and they do not do a 1031 exchange, they will have a withholding that's required by the state of California as a prepayment for their state tax. Remember that state tax we saw on the previous screen was at its highest at 13.3. So what the state of California requires is they require escrow to withhold 3 1/3% of the sales price at the close of escrow to be forwarded to FTB. Now they have a choice, because it's either 3 1/3% of the sales price, or they can actually have the tax person help calculate what their actual gain would be, which for most people is about 12.3 for the state, and figure out what that tax will be, and they can just pay the capital gains tax or the state tax to the FTB instead of withholding. So that could be a choice that the taxpayer pays if they do not do an exchange. There's a few things that are an exception that the withholding does not qualify on, and that is if they did a 1031 exchange that was successful, then they would have no withholding. If there was a loss on the property and there was no gain, there would be no withholding. If the property was held by a corporation, an LLC, a bank, or insurance company, there's no withholding. So it's very important to understand that there are, what the exceptions are. Next, let's go back from, if the client does do a 1031 exchange and they have some money left over in their exchange, so say they sold for $500,000, they bought something for $495, and there's $5,000 left over, just as an example. Then they would have a withholding on that $5,000 of 3 1/3%. So any money that's not reinvested would have this withholding. If there was an exchange that was initiated, that started, and the taxpayer was unable to complete the exchange through the process and then they canceled, then when that exchange ends, there would be a withholding, just like escrow would have taken, that would be paid to FTB for the 3 1/3 or the 12.3. Okay, we're ready to go on. If anybody has any questions, please feel free to put them in the chat. Now, I said a few times that deferring the taxes really isn't the benefit of the 1031, but by deferring the taxes, it allows the taxpayer to be benefited in many ways. So to begin with, it helps them to grow their wealth. I had a client that years ago that sold and bought in the early 70s, single family residence in Huntington Beach. By the time I met him in the early 2000s, he acquired 60 properties by using a 1031 exchange, and all of them were debt-free. So the 1031 exchange was his ability, was his tool that he used to accumulate his wealth. That's just a small example of how people can use the 1031 to increase their wealth. The next thing that I think is very relevant is a 1031 could help improve the cash equity return on the property. So some people may have, and we're going to get into all these details in a few minutes in regards to the debt and cash that has to be spent on a 1031, but it allows someone to sell a property that's not performing like it should, and maybe replace it with something else that would, regardless, maybe changing the asset class or whatever it may be. It allows them to update their portfolio. It also allows them to get a new depreciation schedule. Maybe they own the property and the depreciation has been taken for the whole 27.5 years for single family investment property. And 1031 exchange affords them the opportunity to have that tax benefit back again. Other people have, perhaps they bought a certain type of investment property, and through the years of owning it, they don't like it. They would like to get out of it. So for example, some people have apartments and they want to just go back to having several single family investments, or some people have single family investments and would rather go to commercial. So a 1031 exchange allows the taxpayer to change the type of properties that they have and change their portfolio. It also allows them to diversify and consolidate. So what I mean by diversify, perhaps they have one larger valued property, maybe they're selling something for $10 million. And they can take that one huge asset and spread it out into a lot of smaller assets, all totaling 10 million. Or maybe they have a whole bunch of smaller properties that they want to get rid of and sell them to buy one larger asset. So the 1031 exchange affords the taxpayer that opportunity to diversify or consolidate. And other people move. They start off in, maybe they live in California, but then they move to some other state, Montana or something else. They get settled, they get their kids in school, and then they want to bring their investment property where they are. So a 1031 exchange is a great way for making that change without having a tax hit. And then finally, estate planning. People use the 1031 exchange to do estate planning. I've had many clients through the years that have used this tool for their estate planning purposes, and they've done excellent examples of how to use it and really clean their portfolio. So I had this one woman, she was in her 90s. She had 3 apartment buildings that she wanted to sell, and they were all on the same street in a cul-de-sac, and they were all the same size, the same value. And she had 3 grown kids, like in their 60s. So she wanted to set up her living trust, and she wanted to have kid A inherit one of the apartment complexes, kid B the same, and kid C the last apartment complex. But what she owned was in really bad shape. So she didn't want her kids to inherit those properties because they would have been a money pit for all of them. So what she did is she did a 1031 exchange. She did 3 separate ones, and she used the exchange as her estate planning tool. She told her, kid A, I'm going to sell this property. I'm this apartment complex. I'm the seller. I'm the buyer. So I'm going to buy whatever, a replacement property, but you're going to inherit what I buy. So I want you to pick out what you can manage and take care of. So the kid A went through, found the property. The mom sold, the mom bought, closed escrow, and then put in the family trust that kid A would inherit that property at the time of death. Then kid B did the same thing, sold it, did another exchange. He went out there, bought what he wanted, that he could manage and take care of. And then the mom was the owner of it. And he was the beneficiary in the family trust for that property. And the same thing for kid C. So it took us about 1.5 years to do this transaction because of all the moving parts. But unfortunately, after the year and a half, she only lived about another 6 months, and she did pass away. She was in her mid 90s. But the beautiful thing is after she passed away, I got a call from each of her, grown kids, and all of them were very grateful because they all inherited what they chose, and they didn't get a money pit, and they had things that they knew they could take care of and manage. So she was an excellent example of how you can use the 1031 exchange as an estate planning tool. Okay. Ready for Nancy. Now, remember we talked about the state of California has the withholding during the third, and they can be as high as 13.3 for state tax. For most people, it's 12.3. Well, there's something called the California Clawback. It's a state form 3840 that was created a few years back. And when somebody sells a California property and they leave and maybe go to a non-tax state like Texas or Florida, California or any state, but it's mainly the non-tax states are, probably people think it's a good idea to go to because they think they'll get out of the state California tax. What California has done is they want to keep track of the money owed to them. So if you do a 1031 exchange, you sell a California property and exchange into Texas. You want to keep track. So they use this form called the 3840, the tax CPA or tax professional for the client. And every year this form must be filed. It's called an informational return. And it keeps the state of California informed as the status of this property that they exchanged into. If they sold that and exchanged in something else, then that state form 3840 will still need to be completed every year. Because one day, if they ever sell, being in another state, and they don't do an exchange, that is when the state of California, because they've been tracking it through the years with this 3840 form, that's when the state of California will go back to that original sale that was started in California and get the tax due at that time. So they're not going after any additional tax. There's no additional tax after they left the state of California. It's just their way of tracking that money that should be due to them somewhere down the line if that taxpayer does sell and they do not do the exchange. So I get a lot of phone calls about this, and people think that the state is, unfairly trying to get their money. They're not unusual. There's other states that track their money too. So, but the state of California officially is tracking. If they do have a year that they don't file a 3840, this clawback form, then the state will require that tax to be due. So every year, as long as they own that property, they need to have that 3840 form filed. Okay, thank you. So now we're going to talk about in our exchange discussion today. There's a few different exchanges that we're going to talk about. The traditional exchange, which is the delayed exchange. Simultaneous exchange, which is when the sale and the purchase close within a day of each other. Something called the build-to-suit exchange. We'll talk briefly about that because that's really in our advanced class, and the reverse exchange. So again, we'll talk briefly about that also because that will be in our advanced class. So the delayed exchange. Again, this is the most common exchange in the code. It's called, some people call it the Starker exchange. And this is because of a court ruling in 1979 done by that was awarding Mr. Starker the ability to do a 1031 exchange with a time frame. And we're going to talk about this time frame in more detail, but in the next few slides. But the bottom line for delayed exchange, you sell first, you close escrow. At the close of escrow starts the total time exchange period of 100 days with the first 45 days to identify. And we're going to talk about this clock in great detail in just a few slides. But I just wanted to define, this is what a delayed exchange is. And this is the most common exchange that people do. They use the time frame. Simultaneous exchange is when there's a concurrent closing and the sale property and the replacement property. So this is a little bit controversial because some taxpayers feel that with the 1031 exchange, the way the code is structured, one of the qualifiers in the code is that the taxpayer who's selling and doing the exchange, when their sale escrow closes, they don't have receipt of those funds. Because if they got those funds when escrow closed, it would disqualify them from the exchange. So taking this and going a step farther, a lot of taxpayers feel like if they're doing a concurrent closing with the sale and the purchase closing, maybe sale closing on a Tuesday, the purchase closing on a Wednesday, that would be considered a concurrent. They're not receiving the proceeds. They're just telling escrow on the sale escrow the forward money to the purchase escrow. So because they are not receiving those funds, they feel they don't have to work with a qualified intermediary. Now, a qualified intermediary is the type of company that is necessary to facilitate a 1031 exchange. So the company I work for, Exchange Resources, we're a qualified intermediary. But the problem here is it's not about just receiving the funds. If a taxpayer actually gives instruction to escrow to wire those sale proceeds to the purchase escrow for the closing of that property, they actually have what IRS refers to as constructive receipt of the funds. They have control over what's going to happen with those proceeds. And that control disqualifies the taxpayer. So even though the taxpayer doesn't have, they're not going to receive those proceeds, they still need to work with a qualified intermediary to set up the exchange, and that in the instruction of forwarding, having the sale escrow forward the proceeds to the purchase escrow needs to come from that third party, from the qualified intermediary. This is IRS's required procedure. And so this way, if they had this qualified intermediary working in their behalf, then they have a qualified exchange and they can do it. But if they didn't, and they told escrow to forward those proceeds, they just disqualified themselves from the exchange. So it's very important to understand the need to use a qualified intermediary. And then we're going to talk about towards the end a little bit, not go into too much detail because this is in our advanced class, but there is something called a reverse exchange where it's exactly what it says. You buy first and then sell. So we will talk about that in just in a few, towards the end of the class. And the next thing we're going to talk about towards the end of the class is the bill of suit exchange, which allows someone, if they had perhaps bought land or maybe some property that needed a lot of improvements, there's a way they can use their exchange funds to work on improving the property. And we'll talk about that in the end too. Okay, next up. Now, I think this slide is probably one of the most valuable slides in this presentation, as it deals with the primary residence. And there is a situation where the primary residence, when being sold, can be converted to investment property. And they would have a combination of tax codes that they would use in their benefit. The 121, which is the primary residence exclusion, and the 1031. So how this works is if a taxpayer has a primary residence and they say they've been there for 30 years. And during 30 years, they have a lot of gain that's accumulated. So I'm just going to go with easy numbers since we're just talking and we don't have a whiteboard. Let's just say they have $1 million gain. And of that $1 million gain, and the status of the owner of the property has changed through the years because of either death or divorce. So they started off being a married couple and they could have got $500,000 protected. Now they're single. The person owning this property is single. So her exclusion would be $250,000. So that leaves $750,000 that would be left to be taxed. So a taxpayer could have a choice, or they could opt to utilize both of these tax shoulders, the 121, 1031, But what they would need to do is convert the use. So IRS takes the last 5 years of ownership. That's our scale here, the last 5 years. So if they lived in this property for 30 years, they're 29 and 30. It's the first 2 years, the last 5 years. If they rent out the property for the next 2 years, they move out and rent it out. Then if they sell it before the 5th year is up, then in the last 5 years, they have both uses: primary residence use, investment use. They sell it. Now they qualify for both tax shelters. And what this means in English is they get their primary residence exclusion, so $250 tax-free. Their tax person would calculate now whatever the rest of that gain is. So in our situation, maybe the $750 is what's left over, and they would do their 1031 exchange on that $750, and they could buy investment property with that, buy something perhaps that could provide an income. So now they got their tax-free money, and they were able to defer the rest of the money and have that money work for them. So this is a beautiful situation of a 121 and a 1031. Now, there's other ways that a 1031 could be worked into a primary residence. One could be they have a home-based business that they run out of their house. So in the past, I had a client in Corona del Mar. The basement portion of the house, or the second level of the house, was the construction business. And that was where they ran their business entirely. The next level up was the primary. And it's exactly 50-50. So when they sold that property, 50% of that value of that house was deemed as investment property because it was used for their trade or business. And the other 50% of that property was their primary residence. So they got their primary residence exclusion on the 50% that they lived in. Of course, they paid taxes for any gain over that after 500,000. And then the first level, the value of that 50%, they were able to take that and do a 1031 exchange. So there are situations where 121 and the 1031 are combined. Some people have like a duplex, they live on one side and rent the other side. Again, in this situation, they'll be able to fraction off if both sides are exactly the same size, if both sides are exactly the same size. So say they sold for $2 million and they had one rented out and one they lived in it. One they lived in would be $1 million, 50% of that property, that would be their primary. And the other 50% of that property, another $1 million, they could do a 1031 exchange. And they can buy something separate. It doesn't have to be all combined together like what they did, or they can find something the same type of scenario. So it just helps you to see that it can be mixed use. It just has to be bifurcated out based on percentages and values. Okay, thank you. The next slide, we're not going to really spend a lot again. It's just I wanted to introduce the concept. Was this build a suit? Oh, wait, go ahead. You're going the wrong direction, Tom. Next. There we go. So then in a 1031 exchange, this slide I think is out of order, but we'll talk about it. It says, I found my replacement property, what next? So once the sale escrow closes, it start a time frame that we should be talking about here in the next few slides. And that time frame is a total of 180 days to buy, close, and be done, with the first 45 days to identify. So when somebody finds a replacement property, what's real important is they need to contact us if we're handling the exchange, or whoever their qualified intermediary may be. Then let them know that, give them call the intermediary, give them the escrow information, because there's going to be documents that the qualified intermediary will need to request. There's a cooperation clause that's very important that is put into the contract, that the seller understands that they need to cooperate with the buyer in doing the 1031 exchange. And then there's documents that need to be in place, and the qualified intermediary will take care of that and get the funds to escrow at the right time for closing. But there's a few steps that are missing that we'll get to. I think the slide was put in the wrong place. Okay, so now we're back on track. Like-kind property. So there's a few key words in a 1031 exchange that we hear. One is it needs to be like-kind, and that can be very confusing for people. Some people think that like-kind means that it's got to be the same property, and there's a lot of controversy on top of that. So let's go to the next slide. So these are examples of what like-kind is. Like-kind has nothing to do with the type of property and everything to do with the use. So if someone can sell a rental condo and buy a fourplex, those are not like-kind if you were comparing types of property, but they're like-kind because they're all rented out. They're investment property. Or they can sell a commercial building and buy ranch land, which or vacant land. They can sell and buy residential property used for investment purposes. This is interesting because vacant land, even though there's not an income derived in most cases, sometimes there's things that are leased out on that land, but in most cases there's not an income derived. IRS puts vacant land in its own category, and it is declared as investment property. So even though there may not be an income or there may not be a rental use, IRS deems vacant land as investment property, so it does qualify for a 1031 exchange. So they can sell that land and buy whatever they want, residential. Some people can sell rental property and they buy an easement that's used for investment purposes. You can buy, I'm sure a lot of people have heard about these Delaware Statutory Trusts or DSTs. They can buy that where you buy fractional interest of maybe a larger type of commercial property, like the 300-door apartment complex or something like that. Or they can also have leasehold interest of 30 years or more for income. So if you're selling something that has a leasehold interest on the property, for it to qualify as real estate, the lease with its options must be at least 30 years. And 30 more years or greater. And if it is 30 years or greater, then let's go back to the last one. If it is 30 years or greater, then it is declared as property real estate. It is declared as real estate. And if it's been rented out, then it's investment property. So they can sell something that has a leasehold and buy different type of investment properties, fee simples, change that around, and it does qualify. What's real important is that domestic, for it to qualify for a 1031 exchange, is domestic for domestic and foreign for foreign. So I can't sell my California property and buy in Mexico, or sell in Costa Rica and want to buy in California. I can't do that. It's got to be foreign for foreign and domestic for domestic. Okay. So now we're going to talk about the economics of the exchange. So I think the first thing we talked about was like-kind. That's something we hear so much about. So it's investment use for investment use. Now we're going to talk about the economics of the exchange. So what's really important is to understand that an investor to totally defer all the taxable event, they need to buy equal or greater than what the taxpayer sold for. So let's just start off with that. Let's say somebody sold for 1.1 and they needed somebody, if they're going to want to defer all their gains, capital gains, and do a 1031 exchange, they need to buy equal or greater to that 1.1 with this exception. They can deduct, the non-recurring closing costs. So that is commission, escrow, title, transfer fees, recording fees, exchange fees, inspection fees if there's any, or any contractual agreements between seller and buyer for repairs or credits. So those would be non-recurring closing costs. So knowing that commission, escrow, title, those big labeled things that can come off the top, I say I sell for 1.1. And all the fees, if I added them up, the non-recurring cost 100,000. So that brings me down to 1 million. So I need to buy equal or greater to 1 million to defer all my capital gains events, all the taxable events. So what are fees that are not allowed are recurring fees or fees related to financing. So financing costs that are paid by the seller or buyer, things like origination fees, points, interest, title insurance for the lender. That's a requirement for their loan. Property taxes, HOA fees, fees, the monthly fees. Those are things that are not allowed. So we would not deduct those off the top. So most important, we have 1.1 is my example of sale price. By the time we take out the non-recurring closing costs, we're down to 1 million. Now the 1 million, I have a loan that's being paid off at the close of my sale for 200,000. So that means I'm going to have $800,000 cash. I have $200,000 loan debt. So what's important to understand is that the loan debt does not get deducted out. You need to replace that loan debt with a new loan equal or greater to that payoff amount. So if I was the taxpayer that sold, my net sales price was $1 million. So I can go out there and buy something. Maybe I found something for 1.1. I didn't need to, but I found that. I met my minimum of $1 million. I went a little greater. And now I have a loan on my sale property for 200,000, and I had 800 cash. So now what I'm going to use my 800 cash, but now I'm going to get a new loan for 300,000. So I just replaced the loan debt that I gave up of 200 and increased it by another 100. So that new loan will offset the loan that was paid off. If I did not replace that loan debt, then and bought down, so say I bought for 800,000, then I'm going to pay capital gains tax on the $200,000 loan debt I did not replace. Or maybe I'm retiring and I don't want to have a loan on my investment property. Maybe I want to increase my income. If I have the cash to bring to the table, then I can bring in $200,000 to my purchase escrow. And that new cash will offset loan debt. So there's two options. You replace, if you had a loan on your house, you replace it with a new loan, whatever type that may be. Could be private financing, whatever it may be. Or I bring in new cash to the purchase, and that new cash relieves me from having to replace loan debt. So that's if I had a loan on it. If I didn't have a loan on what I sold, then whatever I buy, I can use all my cash that comes out of the sale. If I buy greater, then that difference, either I bring in more cash to the transaction, or I can get a loan to offset that difference. So we have two categories. If I sell with a loan, I replace it with a new loan or my cash. If I sell and I have no loan, I can use all the proceeds to buy a new property. But if I bought greater, then that difference, either I bring in new cash, more cash to the transaction, or I supplement that difference with a new loan. So what's important to understand is that all the proceeds need to be used in the property or properties that are being bought. Even if I bought greater, so say I bought for 1.5 and I got, my loan debt got increased. So I sold for 1.1 after fees. I had $1 million. I had to buy equal or greater to, but now I went and bought 1.5. If I got a loan that was higher, that I walked away with 300,000, even though I bought greater, I'm going to pay taxes on that money I walked away with. So it's real important that all the cash needs to be used. Now, it doesn't mean you can't do this. It's called a partial exchange. If you had a need and you wanted to exclude some of the money and pay taxes on it, that absolutely can be done in an exchange. But I just wanted to make sure they understand that that's the choice. Don't mistakenly think that they can take money out because they bought equal or greater. They're not. That leaves them with a taxable event that they didn't realize they would have. Okay. So there's two different types of boot. Now, boot is a term that's used to represent a taxable event in the tax code. So there's a cash boot. So any money left over, like we were just talking about, that's on the purchase property that wasn't utilized. Maybe they got a greater loan and they didn't use all the cash, or they bought down, that money would be taxed. Debt boot would be if they didn't replace the loan debt on the property that they sold, then they did not replace the loan debt from the sale property to whatever they bought. Then by not replacing that loan debt, and they did not bring in new cash. So say they just bought, in my example, I said they sold for $1 million. The $1 million was their net, and they had a $200,000 loan debt. So they left them with $800,000 cash. So maybe they just bought with cash, the $800,000. So that loan debt, the debt boot that was not replaced will be taxed. And that may not be, that's up to that client to talk to their CPA or their tax professional, because that's a decision. If they have a huge gain and they want to do a partial exchange, maybe it might be worth paying a little taxes to own it free and clear, the next property. But that's a decision that they need to make with their tax professional so they can make an educated decision. Now, it talks about how long do I have to complete my exchange. So let's just recap. We talked about like kind, then we talked about the replacement value, what they had to buy equal or greater to, and debt boot and cash boot. Now we're going to talk about time frames. So when some person sells or relinquish or their downleg property that we refer to it, then what will happen is at the close of that sale escrow will start the time frame for them to conclude their exchange. Now, if someone's selling more than one property to be in an exchange, so maybe they're selling 3, the first property that closes escrow will start the clock for the whole transaction. So it's real important for strategy, maybe make that first escrow a little longer escrow, and then adjust the escrow periods for the next 2 properties that are being sold. That's only for multiple property sales. So if somebody's selling more than one, it is really important to understand that the first one that closes starts the clock for the whole transaction. Now, as you can see on this diagram here, there's 2 time frames. We see a 45-day and a 180. So the client gets a total from the day after escrow closes of 180 days to buy, close escrow, and be done. That's called the exchange period. The first 45 days of that 180 is separated out for the identification period. And that identification period gives the taxpayer 45 days to identify what they will be closing on. So whatever they identify by, they have up till midnight of that 45th day after the close of escrow. Once the 45th day has passed, so say now we're day 50, so once the 45 days have passed, whatever's on the sheet that they've turned in, because they have to fill out a sheet. There's 2 ways of doing it. We're going to talk about that in a few minutes. They have to turn in a form identifying the property or properties that they're going to buy. Once that sheet's been turned in and the 45th day has passed, now they're bound to have, for their exchange to be successful, they're bound to have to close on one of those properties that they identified on the sheet. So this is really, really important to understand, because once 45 days have passed, there's no substituting properties, there's no changing them. It's set in stone. Inside the 45 days, if they turn in their ID sheet, then they can revoke and re-identify whatever they want to do. But once that 45th day is passed, it's set in stone. These days are not business days, they're calendar days. Holidays do not count. Weekends do not count. Sunday, all those days do count. they're not counted as far as it's where it's a free day. Every one of those days count. So if you were to close on Christmas, the 45th day was up on Christmas, then you really need to identify, or you got to make sure you turn in your identification on Christmas or sooner. Like with us, with fax machines or emails, everything, we won't miss a beat. So it can be turned in on Christmas. But Christmas does not buy you another day. You must, the identification period is business days, not calendar, not holidays. Now, for the 180 days, again, this means that the transaction has to close by the 180th day. So if the 180th day fell on Christmas or fell on Saturday, they need to close before that holiday, the day before, or Friday before the Saturday of the 180th day. That transaction cannot go beyond that 180 days. The only time there's an exception to this rule, and this is what we've seen really recently, is if there's a federally declared disaster in an area. So we had the flooding that we had here in California. Traditionally, what will happen is if the taxpayer lives in a disaster declared county, then if they live in the county, or the real estate they're buying is in the county, or their QI is in the county, their escrow company, the broker, any party pertinent to the transaction, then they could qualify for an extension due to this presidential declaration, and that FEMA came to the aid of the survivors. So there's two criteria that need to be met: presidential declaration, and FEMA. And IRS will send out they send out an alert when it comes to these extensions, and they issue them to the qualified intermediaries. And they'll find out if your area, if there's a disaster, qualifies for an extension. If so, then the qualified intermediary will give them instructions as to how that extension applies to them. Okay, so it's real important. The last thing I want to talk about on this page is that on the very, very bottom, after the red writing from federally declared disaster, it talks about or April 15th. So let's talk about that for a moment. The client has 180 days to close with their whatever they're buying from the close of the sale to they have a total of, 180 days from the close of their sale property to close on their purchase. Or April 15th, which is the date of filing their taxes, whatever comes first. So in any given year, about October 20th, 22nd, somewhere in that neighborhood, till December 31st, in that time frame, when somebody closes on a sale property, April 15th will come before their 180th day. So if they need a whole 180 days because they're buying new construction and the house isn't completed yet, then they need to file an extension to their tax returns and not file their tax returns until their exchange is complete. If they file their tax returns and their exchange is not complete, they have not closed on their upleg or their replacement property, then your exchange is disqualified. This is really important that they understand in that window in that time frame from October 20th-ish to December 31st, they need to either file an extension and they get the whatever remainder days that make up their 180 and not file their tax returns. So I see a question from Cheryl or Sharon. It says, if something changes with the replacement property within the 45 days and you identify a new property, it does not reset the time frame, correct? Correct. So day 30, I changed my ID sheet. I submit it back into the qualified intermediary. I only have 15 days left. So that time clock does not get restarted. There's no way of stopping and starting. It's just a solid 45 days from the day after escrow closes to the 45th day. Okay, I think this is it for this slide. Thank you, Frank. So now I think this is a good place to start talking about strategy for the 45-day identification. So, like it says here, planning is the key. So you want to start planning. Yes, Paul, the presentation is being recorded, so you can get a copy of this through the association. So planning is the key. So you want to start planning before you list. You want to talk to you want to make sure you get all your questions answered before you even get started. So for example, if somebody wants to not replace loan debt, they need to talk to their tax person, their tax professional, their CPA, and find out what does that mean for them in dollars and cents? How much money am I going to pay taxes if I don't replace this $200,000 loan? Or maybe I want to have some cash out to pay off some bills. Well, whatever that amount of money that you want to have out, exclude it from the exchange. You need to talk to the client needs to talk to a tax professional so they understand. How much would my taxes be if I did not do an exchange versus doing an exchange? Because in that way, it sort of helps them too to see how diligent they may be in working on getting this exchange completed. Other things would be questions about 1031. They need to talk to a qualified intermediary, get all their questions answered. So when they start selling that property, going into the contract, they can just run with it. They know exactly what they're going to do. Maybe with their real estate professional, they have questions about finding a particular type of replacement property. So do all your homework up front and start planning and talk to all the professionals you need to get the answers they need to make this work. So when in escrow, when they actually sell their relinquish or sell property, at that point, it's really important to start looking for the property that they're going to be buying. I know that this can be a little dicey. Sometimes people will be like, if there's a contingency on it, nobody wants to deal with that. But this is where it takes you guys, the real estate professionals, to help your client figure things out. Because maybe on the property they're selling, they can work to get a little bit longer escrow. So what I mean, instead of a 30-day escrow, maybe they can get a 45-day escrow or a 60-day escrow. And I'm not saying this has to be, I'm just throwing out ideas because this gives them a little cushion before the real clock starts ticking. So it's just a strategy. So if they are looking for something that may be a little bit difficult to find, if they had a 60-day escrow, that gives them 60 days to be out there looking, presenting offers before their sale property closes and the real 45 days starts ticking. Okay, so that gives them a little bonus time. They can also use the CAR form, which is the buyer's intent to exchange supplement. And there's a sample of that right here on the screen where it's sort of everything's negotiated up front. So on the screen, it's hard to see, but they can choose B, close of escrow date, or you can say you want an extension to that close of escrow by, and over to the right, there's a yellow box in the line that highlights how many days you choose for an extension to the close of escrow. So somebody may want 2-week extension. If need be, it gets all pre-negotiated up front. So if it turns out that it's time to close and that extension is necessary for the seller for the sake of their exchange, this form afforded them the opportunity to do that. So I'm not saying it has to be done, but it's a tool in the toolbox that may be used, and not every circumstance dictates it using it, but at times it can be the perfect tool for the right transaction. Okay, let's go on to the next. So when somebody does a 1031 exchange and they're selling their sale property, we call that the relinquished property. There's verbiage that really needs to go into the contract. So you can do that by means of an addendum. And the verbiage is basically what you see here. Versus buyer hereby acknowledges it's the intent of the seller to effect an IRC section 1031 tax deferred exchange, which will not delay the closing or cause additional expense to the buyer. So that's real important to have that verbiage in the contract. You can use this CAR form also And this car form has the verbiage built into the transaction, into this form. So you can use that. So, but whatever, if sometimes maybe nobody knew that the taxpayer wanted to do an exchange. So once it's an escrow, if that's the case, there can be an addendum to the contract that changes that, showing that the seller's doing the exchange or the buyer's doing the exchange. Or if escrow, just matters where they are in the transaction, escrow may even do an amendment to the escrow instructions, but usually they have them do an addendum to the contract, because the contract is the escrow instructions. Okay, we're done. Thank you. Okay, where are we? Does anybody need to take a quick break for restroom or anything like that? Why don't we do a quick restroom break for maybe 5 minutes? So we can come back, what is it, 3:04? It's at 3:10. Let's come back so that we can have a little break and then get some water, go to the restroom. We'll be right back, okay? Great, thank you. Five minutes. Oh, 5-minute break. Okay, 3:09. We'll be back. Okay, let's go ahead and get back started back. Welcome back. Okay, so now we're going to talk about the identification process of the replacement property. And this is very confusing for a lot of people because there's two rules and they want to combine these rules a lot of times. So we're going to separate these rules and talk about what would be the best circumstance for each of these rules. So the first rule when it comes to identifying properties, the 3-property rule, second one's the 200%. So we'll go to the next slide and we'll talk about the 3-property rule. This is a sample of what the identification sheet looks like. It has a space for 3 different properties. And so this 3-property rule is exactly what it says. The taxpayer has a max of 3 properties that they can identify. They can identify 1, they can identify 2 or 3, but not more than 3. And this rule also, there's no value criteria, so they can identify property as high as they can afford. So they have up to 3 properties, they can identify whatever they want, up to as high as they can afford. Some people want maybe to take a larger asset and buy maybe 3 different properties, so they can do that. And it's the combined value of everything they buy that adds up to that equal or greater to the property they sold. Okay, so that's the 3-property rule. And I think the best circumstance for this rule would be for 3-property rule would be if someone sold 1 piece of property and wanted to buy one or 2 properties, maybe even up to 3, but nothing more than that. That would be the best way. So let's go to the next rule. The 200% rule. Now this is what causes a lot of confusion for a lot of people. So some people are selling a larger value property and they want to take that sale and break it out into a lot of smaller value properties. Then this rule is the perfect rule for that. So what they do, hence the 200% rule, is they actually double their sales price, not their net sales price, not their gain, but their actual contracted sales price. So if I sold for $1 million, that's on my contract, that's my sales price, and I double that. So now I have $2 million and I can buy, and then I can buy as many properties as I want, but I cannot exceed that doubled amount. So if I was going out of state, some other location, I bought a lot of raw land, maybe I could buy more than 3 properties with that $2 million, which is 200% of my sales price, $1 million. Some people, though, want to buy more properties than, and it turns out that that value of each of those properties that they buy may exceed that doubled amount, that 2 million in my example. If that happens, then they do have an option. They can proceed with their exchange. They'd use this 95% exception rule. And basically what this rule is that it basically it means that they would have to buy 95% of what they identify and close on that. So logically, they have to buy everything on that list. If they can't close on everything on that list, then their exchange will be disqualified. So I tell people to really veer away from, exceeding that doubled amount, because it's really a dicey game to play. But if they can stay within that 200% value, then they'll have a perfect exchange. So say I sold for $5 million, 200% of that would be 10 million. And I identified 5 properties and they came up to $9 million. That's beautiful. I did not exceed the doubled amount, so that worked out fine. And then I can buy whatever I can on that list, close on whatever I want on that list to match my 5 million that I sold. Okay, so you just need to buy equal or greater to your sales price, even though you're identifying double. So you're not being forced to buy double amount, which just gives you a way to have more properties on this ID sheet. Okay, I hope that answers the question. So this is a good example. Let's go back to the example. Somebody sold something for $550. They times it to 200%. That's the 200% rule. It's 1.1. And they reference each of these properties, and each of them have a value. And you add up those values and they come up to 1.1. And the value that's posted is the value that's known at that time. So if it's something that's not negotiated, it's what's listed in the listing. If it is negotiated, it's the contracted sales price. So it's the value known at that time. So that's the value that you need to put on there. Okay, let's go to the next slide. So now this is very, very important, this next slide, when it comes to an exchange. And this is something I feel personally that needs to be handled on the listing side. When you're working with the taxpayer that wanting to sell a property, doing a 1031 exchange, we really need to check into this on that side when they're selling a relinquished property. So the basic rule here is the same taxpayer who held the title to the sale property or the relinquished property must be the same taxpayer who hold title to the replacement property. So as far as IRS is concerned, all we are is a number to them. So what we want to see is up below, you see John Smith was the seller, then John Smith needs to be the buyer. And John Smith is identified to IRS by his Social Security number. So on the sales side, John Smith as an individual is referenced with the Social Security number, and John Smith as a buyer will be referenced. So John Smith in a trust, we have John Smith in a revocable trust, is exactly the same as John Smith out of the trust, because the trust is set up under his Social Security number. So in the trust and out of the trust, it's the same taxpayer. It didn't change. Now, a single member LLC is also can be very important. It's a good tool because the single member LLC is set up under the taxpayer's Social Security number. They're not necessarily, and it's filed in their tax returns, not with the K-1 with its own taxpayer ID number. So if I say I'm Debbie Bannister and say I'm a single person, I have a single member LLC that I create. It's being created under my Social Security number. So basically, I'm the same taxpayer in the LLC and out of the LLC because it's set up under my Social Security number. So those three are important to know. Tenants in common is another way that people hold title. So if there's 4 of us in the room that hold title to this property as tenants in common, like you'd have Debbie Bannister, 25%, Frank Doe, 25%, and 2 other parties, 25%, as tenants in common. Each of us, because we're referenced on the deed with our percentage, each of us can take our percentage and do what we want to do and not affect the other party. So if I choose to take my percent and pay taxes on it, but my partner, Frank Doe, wants to do 1031 exchange on his 25%, then he can do a 1031 exchange on his part. I can pay taxes on my part. The other 2 partners can do what they want to do with their part. So that is a beautiful way of having a couple of people in title where everybody has the freedom to do what they want with their percentage. If there's 2 people on title and there's no percentages there, then it's legally implied that it's 50-50. Or there's 3 people on title, there's no percentages, then it's legally implied that it's a third, and third. So, but it's very important if they're doing an exchange and some people buy into a replacement property with a certain percentage, very important to show that percentage. So what is confusing are LLCs and limited partnerships and corporations. Okay, so this is a different category because these entities are created with their own taxpayer ID number, their own EIN number. And there may be like 2 members to that LLC, but each member, these members are not, and this LLC may own one piece of property and there's only 2 members. So a lot of people mistakenly think that because there's only 2 members, that each of them get 50% of that property and they can go any way, they can sell it and each of them take their 50% and do what they want. That's not the way it works. Because in this situation, the LLC has been reporting that property, that investment property, and the members are not the owners, that LLC is the owner of the property. So if you have on your listing appointment, when you pull up the property profile and you're with the client and it shows some sort of LLC, you want to ask them, who are the members of the LLC? What is it? If they say it's just me, a single person, then then that's fine. That's not an issue. But if they say, well, there's 3 parties that are together, then they need to talk to the tax professional and need to talk to their qualified intermediary. Because if everybody wants, if everything's staying the same and that LLC is just going to sell something, that LLC will buy something, then there's no problem. The problem arises when everybody thinks they can separate out. Because by the time you list that property, it's too late to separate everybody out. The separation takes time to make this happen, according to the way IRS and state of California work. So basically, they would have to separate at least 2 tax returns, 2 years, or maybe minimally 2 tax returns before the sale, where they drop out of this, and then deed it to them as tenants in common, or the entity can sell, and they need to report it for maybe 2 tax returns, and then they can drop out at that time. But it's not an easy fix. So if there's any of that coming up, if you have any clients or potential clients you're working with, you need to have them talk to their tax people if they want to separate out, and their QI. Okay. So we started talking about this. There's certain things you want to pay attention for the listing appointment, certain things you want to watch out for. So like I said, when you take the listing, you should ask who your seller is. If there's an LLC, who's really comprised in that LLC. It's really important with a person, I think, on a listing appointment, if they're not talking about doing a 1031 exchange and it's investment property, then you can just ask them a simple question without going out of your lane. You can ask them, what are you planning to do with the proceeds that come out of the sale? If that potential seller says, I'm going to buy more investment property, then they need a 1031 exchange, most likely. If they say, I don't know, I've been an investor, I've been managing property for 30 years, I'm sick and tired of it, I'm done, I don't care, I want to pay the tax. That is a person that you need to have them talk to their tax professional before they even accept an offer. Because after talking to the tax professional, you can give them a guesstimated amount of the sales price, guesstimated amount of fees, let the CPA do the number crunching, figure out what their taxable debt would be. And if that taxpayer can live with that number, then that's great. Then go ahead and list the property, sell it. They don't need to do an exchange because they understand how much taxes they're going to pay. But what I've found in my history of working with exchanges and investors, that some of them get really emotional. It's an emotional decision they're making. They don't want to go into more investment property. They're burned out. They're done. And then they sell and get done. And then later they file their taxes and they find out what their taxable event would be. They're having a meltdown. And so now they're calling, seeing if it's too late. Now, mind you, it's 6 months later, maybe. And they're calling around, seeing if it's too late to do an exchange because they don't want to pay those taxes. So watch out for the emotional decisions. Help your client help themselves by talking to their tax person, figuring out if they don't want to do an exchange, how much that taxable event will be. And sometimes I've seen many times through the years that as adamant as somebody is saying they don't want to do that after they talk to the tax person, now they come back and say, yeah, about that. I think I need to do an exchange. I'm not willing to pay $400,000 to the government or whatever it may be. They're not willing to do that. So don't believe them. I guess that's the moral of this story. Don't believe them. Okay, let's go on to the next slide. So now you're past the listing appointment, you figure out who the taxpayer is, you know that they want to do an exchange, you get an idea of what they want to buy. So that's going on over here to the side. But when they do sell their investment property, there's a process that has to take place to initiate their exchange and get the exchange set up. So they would need to call the qualified intermediary if they want to work with us and give us a call. And then we would request escrow instructions, the escrow company, get all the contact information we can so that we can contact escrow, request the escrow instructions, the contract, and the preliminary title report. So those are the forms that we need to get so that we can open the exchange and create an exchange agreement. And the exchange agreement is comprised of a couple sections. There's the agreement itself, which is code. It references the tax code and what the rules are. Then there's something called the assignment of rights, where the taxpayer technically assigns the right as a seller to us so that we can complete the exchange for them in behalf of the tax code and following through compliant, making sure everything's compliant to IRS's section 1031 and to the state of California. And then we also have the instruction letter that we prepare for escrow, informing them of everything they need to do so that this can be done successfully. So the exchange must be open before escrow closes on what they're selling. Anybody that calls and the transaction's already closed is too late. Our hands are tied. There's nothing we can do about trying to set up that exchange. So please, in the escrow process is when the exchange needs to be set up. And to open the exchange, the qualified intermediary, all of us require the same. We need to have the escrow information so we can contact escrow to request the documents that we need. Okay. Is that good? Oh. There we go. So then bottom line is, if you have someone that needs to do a 1031 exchange, I think the most important thing to understand is that it seems for a lot of our clients, it can seem daunting, but with the advanced planning and with the right consulting that goes in place with that planning, then I've seen more successful exchanges than failed. So for example, the slide I wanted to talk about a little bit that I thought we were going to have another slide was the reverse exchange. When somebody does a reverse exchange, some people want to do that because it takes away the stress of buying. Let's get the right slide. There we go. It takes away the stress of going through the 45 days of finding that replacement property. So what happens is they find the perfect replacement property up front. And if they have the resources to buy, then we can proceed with this reverse. But the reverse is a little, from a tax code perspective, it's one of the most complicated exchanges in the code for the qualified intermediary. But that's our business. We know that. For the taxpayer itself, it's probably the simplest exchange they did and stress-free, because for a lot of these taxpayers, it's all about finding that perfect replacement property. So if they found that perfect replacement property, then most important it is, if we went ahead and proceeded with the reverse, IRS has their procedure in place where we would actually create a shell corporation. And then we need to determine what they're selling or what they're buying. One of those properties need to get deeded to the corporation. If they're buying with financing, then we won't touch that property because no lender will allow us to be on title with the shell corporation with no assets and give them a loan. So we leave that alone and let that property would be in the name of the taxpayer. We take the property that they're selling and we deed it to the corporation. And that would have to be deeded a few days before escrow closes on what they're buying. If they're buying with cash and there's no financing, then we deed the replacement property to that corporation. So now they don't own both properties at the same time, and they can continue on with their exchange. So this type of exchange is phenomenal, because then at the close of the purchase, basically, at the close of the purchase, they have 180 days to sell what they have to sell. And then those proceeds are used to reimburse the taxpayer the money they got to buy that property. So it can be a pretty smooth deal, actually. So reverse exchange, I got a note here in the thing, how much does the service cost? So for a traditional exchange, for one sale and one purchase, the fee is a flat fee of $12.50. A reverse exchange is a flat fee of $8,000 because of creating the corporation and all the legal work that goes involved in it. But again, if it means having a successful exchange without half the stress, and if their taxable event would be, if they're going to pay $300,000 or $250,000 of taxes, if they didn't do an exchange, then the reverse really can make sense for them. It's not for everybody, but for the right person, it can be the perfect tool. So that is, in this market, it seems to be a sought after tool. A lot of people are trying to do reverses because it's hard to find the inventory. It's not there, and it's hard to find that replacement property that they want. So I just wanted to bring that up. So in just recapping, I think the most important thing to know is that exchanges, people sort of shy away from them because they think they're a lot more intimidating or very difficult. I think the most difficult thing about an exchange is finding the right person to work with that understands the code, that can explain what the taxpayer needs to do, and that can coach your clients to how to have a successful exchange. Then understanding the time frame. That 45 days and 180 day, it's non-negotiable. So that clock starts the day after escrow closes. So we just want to make sure that you can negotiate, maybe work out a little longer escrow to the sale property. And with that little longer escrow, you may be buying your client the right amount of time so that gives them a bonus in finding the replacement property. And then remember that if they have a total of 180 days or April 15th, whatever comes first. So if they need all that 180 days because they're buying new construction or something like that, then they need to file an extension for their tax returns. Do not file their tax returns. They have to file an extension so that they can complete their 180 days. And then when their exchange is complete, they can file the tax returns. Okay, is there any other questions that people have? I went through this a little faster than I thought I would. You're welcome, Suzanne. So if there's any questions, my name again is Debbie Bannister. I have my illustrious partner, Frank. My number is, I think it's posted on the front, or maybe you can go to the screen. There we go. You got both of our numbers here. You're able to, if you have any questions with clients, people say, when's the best time to call us? Whatever works for you guys. If we can help a client before they start listing the property and answering the questions, then that is a win-win for everybody because it really puts everybody on the right path and they understand what they need to do. But anytime, even if you're in the middle of a transaction, and the client says all of a sudden in the 11th hour before closing escrow, they need to do an exchange, feel free to call us and we'll be happy to help. I saw something, Frank, he talks too much. Yeah, he's just a talker, like Frank.
I saw that.
Did you see that?
Tom, yes. Huh. Well noted, Tom. I'll be quiet now.
I'm bad. I love it. That was good, Tom. So if there's any other questions, I'm sorry that we're that we went through it a little fast, but if you guys do know how to get a hold of us, so feel free to contact us with any questions.
Debbie, we had a question on the replacement property being new construction.
Yes, it can be new construction, but remember, that construction needs to be completed. They need to be able to close that property by their 180th day. So somebody's buying new construction and the ground hasn't been broken yet, it's better not to sell yet. Get in the contract, put the deposit down on what they're buying, and then wait till its completion date is January 2024, and maybe wait till November or October, November to put the relinquished property in the market. And then that way they'll be able to close and not have any worry of not running out of their 180-day clock. So they just need to coordinate the sale property with the closing date of the new construction. I hope that makes sense. Who is that? Who is it that asked that? Suzanne, I hope that makes sense.
Suzanne, yeah. Suzanne Mata.
Okay. Perfect. She said, yes, it makes sense. So yes, thank you. Okay.
Oh, we have another question. Do we have ongoing classes? That's from Dan Morgan.
Hi,
yes,
Dan.
we do that. Yeah. We do, Dan. Sometimes we go to real estate offices, or if you need a class or a one-on-one, we are available for those. And we
yes. Oh, go ahead, Frank.
Yeah. And I believe we have maybe another class with the association later this year.
Yes, we have. I think we have 3 of them for this year. Also, so if you want any in-class training in your offices, you can contact us to talk to your manager. We come into your office and do it. We can do one-on-one, whatever. We also have a few more classes with the Orange County Association. So, but contact us. We'd be happy to help educate anywhere we can. There's a question from, is it Jessica?
Jessica.
She says, can you go over the 95% exception a little more when you were going over the 3 property rule, 200 property rule? Okay, so the 3 property rule does not use the 95% exception. The 3 property rule is just 1, 2, or 3 properties, that's it. You cannot have more than 3. So that we'll put off to the side. But when you do the 200% rule and you double your sales price, so let's say I sold something for $2 million. I'm going to double that. Now I've got $4 million. I can identify as many properties with a value that I cannot exceed $4 million. But maybe one of my properties I really want, and I exceeded it. I went by 4.1 million. Well, if I did that, I can opt to use the 95% exception. But what that means is that everything I identified on that ID sheet, let's say I identified 4 properties, everything on, and they all added up to 4.1. I have to close on everything on that sheet. If I cannot close escrow on everything on that sheet, then I just disqualified myself from doing an exchange. Does that make sense? You said you didn't quite understand it. Did that help, Jessica? Perfect. She said yes. Okay, so that's why that rule can be a little dicey, because can we guarantee that you can close on everything that you identified if you went over that amount? I had that one time where I helped a client that sold property in Mission Viejo, and he bought several properties in a tract new development in Florida, and they allowed investors to go in. But he exceeded his 95, he exceeded his 200% by maybe 100,000 or something. I can't quite remember all the details now. And I personally was stressing for this client because he had a lot of money at risk if anything fell apart. And he bought new construction and used cash. So he didn't have any loans. So he had no issues as far as it closing. And everything was like in the last phase of development. So there's no problem with it closing. And he was able to do that successfully. But that's the first time I saw it done successfully. It was, I think I was more stressed than the taxpayer was, because I was really worried about him. But I would say steer away from the 95% if possible. Okay. Anything else? I'm glad you enjoyed the information. If you have any questions, please feel free to reach out to either Frank or myself. We'll be happy to answer any of your questions that may come up, or any clients that have questions. We'll be happy for us to sort of vet out the situation, make sure it qualifies, and see how we can help your client do a successful transaction. Okay.
Thank you for sharing the classes, Elsie, the upcoming classes.
Yes, thank you for that. Debbie, for just one thing. Perfect, Paul.
Paul, okay.
Elsie will help you with it, because the Orange County Association will take care of that.
Paul, can you maybe call me with your email, or you can text it to me, and I will get that scheduled for you. Thank you. Well, that's great. Thank you, Paul.
Perfect. Do you get that from?
Sure do. Yeah.
Perfect. Okay, so we have a class 323 and 615. Okay. If there's no other questions, I guess we're adjourned for the day. Is there any other questions before we start closing out? Okay. Well, it was such a pleasure. It was an extreme pleasure to be with all you guys today. It's something that we're passionate about, is 1031 exchanges, and helping you guys so that you can help your clients to have a successful transaction. So anytime you want to reach out to us, let us know. Frank also has a marketing package that he would be very happy to send out that could help you do mailings and to non-owner occupied farms, and he has great suggestions. So feel free to reach out to Frank. You can either call him at his number or text him to that number that's on the screen, and he will email you the packages that he has to send out. Is there anything else you'd like to include, Frank?
I think you covered it all. Nice, Debbie. Thank you. Good job.
You're welcome. Okay, everybody.
Thank you.
Have a great rest of your day.
Bye.
Bye.